What's up, you guys? I'm Dan. This is Frugal Not Cheap. I was recently helping a friend of mine with his investment strategy, and we settled upon a very simple investment strategy that's commonly known as VT and chill. So you may have heard the phrase Netflix and chill as a kind of low effort date idea, and basically some investors on the Bogleheads forums, and I think also on some subreddits, have started to use a very similar phrase to describe an investment strategy, which of course is VT and chill. The first part, VT, refers of course to the fund that we're actually going to be buying. In this case, it's an ETF or an exchange traded fund, which is the Vanguard Total World Stock ETF. As is common with Vanguard funds, there is of course a mutual fund counterpart that is VTWAX. So both of these are basically market capitalization weighted index funds that track the total global stock market. Longtime viewers will know that I'm an index fund investor myself, despite having been a professional commodities trader. And I also expand on my thinking in another older video about my overall investment philosophy. For the purposes of today's video, we'll just talk about the basic idea. The first being that I want to have a lot of diversification. I don't want to have all my eggs in one basket or too few baskets. Second is market cap weightings. In other words, I'm going to let the market decide where to allocate capital rather than me trying to be smarter than the market and do it myself. And third, having low fees. Any fees will be eating into my returns over time, and especially with a long time horizon, those fees are going to be eating in a compounding fashion at my returns and putting a real drag on my portfolio. Looking at these three criteria, or these three aspects, VT certainly fits the bill. If I were to buy VT, then I would have exposure to 9,980 stocks, basically 10,000. So this is going to provide a wide diversity across companies. Not only are we diversified across companies, but we're also diversified across regions and even specific countries. The bulk of it is in North America, but we still do have some exposure, about 10% to emerging markets, about 10% to the Pacific as well, and then another 14 to 15% in Europe. On a country basis, we're just over 63% US, and then the next largest countries by holding are Japan, the United Kingdom, China, Canada, France, Germany, and India. Now, how are sort of these country shares determined? Well, again, because this is a market capitalization weighted index fund, in other words, however big the market cap is, that's how much we buy, then really the market is determining how much of each country we're going to be invested in this index fund. Again, this is because I don't think that I can pick stocks any better, at least not consistently over the long run, than the market can. So I'm just going to let that market do it for me. In fact, the data shows that basically no one can, even fancy hedge fund managers and also hotshot mutual fund managers. A famous bet between Warren Buffett and hedge fund managers basically showed that sort of passive index fund investors can beat those hedge fund managers over the long run. Regarding both these hedge fund managers and also hotshot, mutual fund managers, while they may be able to have some success for a while, it's very difficult to maintain that over the long run. And here we define success as actually beating the market, not just providing some, base level of returns. In fact, data shows that depending on the index, between 88% and just under 97% of funds are unable to beat the market over a period of 20 years or more. Okay, so that's diversification, and also market cap weightings are basically the reason why index funds. And lastly, VT fits the bill for me because it has very low fees. VT's expense ratio is just 0.06%, and the mutual fund version, VTWAX, is still very low at 0.09%. By comparison, an average, according to NerdWallet, of actively managed mutual funds for the expense ratio would be 0.65%. Now, I know that doesn't sound like a big deal, but over time, this really adds up. Let's say that we were to invest $1,000 initially and invest $10,000 per year for a 30-year time frame. So I think this is not too, out of the realm of possibility for a lot of people. If we were to earn an inflation-adjusted 7% per year, which is, basically what the market has been returning for a long time, then we would end up with just over $1 million after that 30-year period. And in terms of expenses, we would pay about $11,500. By contrast, if we were to pay that 0.65% for active management, our portfolio would be significantly less at $900,000, and we would have paid over $117,000 in fees. Now again, that's assuming that these active fund managers were able to match the market, and as we showed that something like 90% plus were unable to even do that over the course of 20 years or more, meaning that our actual returns are likely to be lower. Let's say that the returns were 2 percentage points below the market. In that case, we'd end up with just $624,000 instead of the million that we could have had in the index fund scenario. Now, all this being said, do I think that VT and chill makes sense for everyone? Well, no. And, I should point out, by the way, this is not personalized investment advice. This is just, food for thought on investment strategy that ended up being the right choice, we think, for my friend. And that's based on a lot of factors, including his investment time horizon, which is long, and also his personal risk tolerance, which is high. He's able to weather the ups and downs of the stock market and not freak out and sell when things are going south, and not jump on the bandwagon when everyone else is doing it and that kind of thing. I mentioned this particular part because VT is a stock-only portfolio. Other people might not be able to tolerate the swings of a 100% equity portfolio, and so maybe having some other assets that are less volatile, like bonds, may be more appropriate for them. And of course, beyond bonds, there are other asset classes that an investor could consider as well. Another consideration with VT is that not everyone might like to have 63.5% of their portfolio based in the US. They may have a home market bias for a different country, or they might just think that actually the US bias should be higher, so it could go either way. But the market cap weighted 63.5% might not be the best fit for everyone. Personally, what I do is I basically have VT, but I do it by owning 2 funds instead of 1. So it's a little bit less simple. I own VTI, which is the total US stock market, and VXUS, which is the total ex-US stock market. VXUS makes sense, haha. VTI is 3,526 stocks. VXUS is composed of 8,615. So that gives us a total of just over 12,000 stocks. 12,141 to be precise, and that is more than the under 10,000 that we had with just VT, but it's not a huge difference, okay? But just a little bit more diversification, not a huge deal. What is perhaps a more important consideration? Well, actually, there are 2 things. The first is in terms of putting your portfolio in terms of the tax advantage status. So there are certain things that you might want to have in a taxable brokerage account that you might, prefer not to have in a 401k or a Roth IRA and that kind of thing. So, placement does matter. I do have a video on that. In my particular case, because I expect to have a low marginal tax rate in retirement, it makes sense to take advantage of the foreign tax credit by having the international stocks in my taxable brokerage account while having my US stocks heavier into my sort of tax sheltered type accounts. For other people that might have a higher expected marginal tax rate in retirement, it might make more sense to forego the foreign tax credit, but then minimize dividends and also maximize qualified dividends by having more of the US stuff in their taxable brokerage account. So that's kind of a trade-off that's possible, and it will depend on a person's individual situation. On top of that, there's also tax loss or tax gain harvesting that becomes a little bit more difficult with VT than when you have VTI and VXUS with their tax loss harvesting partners. So in brief, I would say that if I just wanted to keep things simple and all I had was, say, my 401k or something, that's the only place I'm going to invest in, then yeah, VT would absolutely be a totally decent solution for me rather than the VXUS and VTI combination. Now, we've talked about VT, but the phrase is VT and chill. And the chill part is actually really, really important. You see, people are constantly messing with their portfolios. In fact, I saw this even with my friend where we got the VT and chill, but he didn't exactly chill. He started adding little bits and bobs of other funds and other things. And basically doing that goes exactly against the philosophy that we're adopting by getting index funds. The whole point of VT, of index funds, is that the market knows how to allocate capital better than we can. So anytime we start to mess with that, we're saying that we can do better than the market. Not only that, but we're also missing really what the idea is behind asset allocation and having a portfolio. So I know we do all these, sometimes people are prone to doing these mental gymnastics where they're like, oh, I bought this fund and I bought this fund and this fund and this fund. And they're kind of thinking them, I don't know, I think of it as they're sort of thinking about different horses that they've kind of like placed bets on or something. But the thing about it is you have only one book. To use the sports jargon, sports betting jargon, or really in this case what we're talking about is one portfolio. And so what you're really doing when, say, like you bought VT and then you're like, oh, I want to buy some REITs, all you're doing is you're slightly increasing your exposure to real estate within your portfolio and decreasing your overall share of all the other stuff, proportionately a little bit. And so let's say we were to like buy, I don't know, more of VOO, the S&P 500, then you're just like becoming more overweight on the large cap stocks in the US, for instance. So yeah, people tend to not think about what they're doing to their portfolio. They're just thinking like, oh, I want to have a little bit of this, So hopefully that makes sense. I really like having software that, like empowers personal dashboard, or Quicken does that for me, or even just my spreadsheets, that gives me an overall sense of what my whole portfolio holdings actually are, and do those match my investment objectives. So just to hammer home this whole thing about how I can't manage capital or allocate capital better than the market can in the long run consistently, Fidelity did this great study of their accounts. Who are the investors that they have who are coming up with the greatest returns, and it turned out to be the ones that basically chilled. And they chilled because they completely forgot that they had an account at Fidelity. So that's why the phrase is VT and chill. There you have it, guys. Hope you enjoyed today's video. If you did, please hit the like button and consider subscribing. Thank you very much for watching, and I'll see you in the next video.